Financial statements are essential tools for evaluating the financial health of a company. Investors, analysts, and regulators rely on these statements to make informed decisions about a company's viability, profitability, and stability. However, financial statements can be manipulated or obscured in ways that make a company appear healthier than it actually is. Recognizing potential red flags in these documents is crucial to avoid making misguided investment decisions. In this video, we'll explore the top 10 red flags in financial statements that can indicate trouble for a company. 1. Consistent decline in revenue. Revenue is the lifeblood of any company, and a consistent decline in revenue over time is a major warning sign. A shrinking revenue stream could indicate weakening demand for a company's products or services, declining market share, or poor operational performance. It could also suggest that the company is struggling to maintain customer loyalty. Solution. Look at the company's revenue trends over the past few years. A steady decline without a clear strategic plan for recovery is a serious concern. 2. Unexplained increase in accounts receivable. Accounts receivable represents money owed to the company by customers. If there's a sudden increase in this balance without a corresponding rise in sales, it could signal that the company is struggling to collect payments, possibly due to poor credit policies, weakening customer creditworthiness, or overly aggressive sales tactics. Solution. Investigate the company's accounts receivable turnover ratio. A growing accounts receivable balance alongside stagnant or declining sales could be a red flag. 3. Unusual changes in inventory levels. Inventory levels that fluctuate significantly without explanation can be a red flag. If a company is holding too much unsold inventory, it could be an indication of poor sales, overproduction, or outdated products. On the other hand, understocking inventory can signal supply chain issues or insufficient preparation for demand. Solution. Compare current inventory levels with past years and industry benchmarks. Excessive inventory buildup or rapid depletion without a clear reason should be examined closely. 4. High levels of debt. A company's debt levels can be an indicator of financial stability or instability. While some debt is normal for businesses looking to expand, higher increasing levels of debt relative to equity or earnings can signal financial distress. It's crucial to look for debt-to-equity ratios that are higher than industry norms or unsustainable debt servicing requirements. Solution. Review the company's debt-to-equity ratio and interest coverage ratio. A high level of debt with limited ability to pay it off could lead to liquidity problems or bankruptcy. 5. Negative cash flow. Cash flow is critical for the daily operations of a company. Negative cash flow, particularly over extended periods, signals that the company is not generating enough money from its core business to cover its expenses. This is especially concerning if the company relies on external financing to fund operations rather than its own revenue generation. Solution. Examine the company's operating cash flow. Negative cash flow in the long term is a significant red flag that needs further scrutiny. 6. Frequent changes in accounting policies. Frequent changes in accounting policies or methods can be a sign of manipulation. Companies may alter their accounting practices to artificially inflate profits or reduce expenses. For example, changes in how revenue is recognized or how depreciation is calculated can dramatically impact reported earnings. Solution. Look for notes in the financial statements that explain any changes in accounting policies. Significant and frequent changes should raise questions about the company's transparency and integrity. 7. Large off-balance sheet transactions. Off-balance sheet transactions, such as joint ventures, special purpose entities, SPES, and operating leases, can hide liabilities or inflate assets. These transactions may be used to keep certain obligations or risky ventures off the balance sheet to present a more favorable financial position. Solution. Investigate the company's off-balance sheet arrangements. Any large or unusual off-balance sheet items should be scrutinized, as they can obscure the true financial condition of the company. 8. Inconsistent or non-existent profit margins. A company should have predictable and consistent profit margins over time. Fluctuations in profit margins, especially if they diverge significantly from industry norms, may be a red flag. For example, a company showing increasing revenues but stagnant or declining profit margins may be sacrificing profitability for growth, or worse, engaging in unsustainable practices. Solution: analyze profit margin trends over time and compare them to industry peers. Large discrepancies should prompt deeper investigation into the company's cost structure and operational efficiency. 9. Lack of transparency in notes to financial statements. The notes to financial statements provide additional context and details that are not apparent from the raw numbers. A lack of transparency or vague, generalized language in these notes could be a deliberate attempt to hide unfavorable details, such as lawsuits, regulatory issues, or risks. Solution: carefully review the notes accompanying the financial statements. Any attempt to obscure critical information, like significant risks or liabilities, should be taken as a warning. 10. Sudden executive or staff turnover. While not directly related to the financial statements, high executive turnover or sudden changes in key leadership positions can be a signal of internal instability, poor management, or potential fraud. In such cases, financial manipulation or poor decision-making could follow. Solution: pay attention to news regarding executive changes or restructuring within the company. Frequent changes in leadership could indicate problems within the corporate culture or management team, which may reflect poorly on financial performance. Financial statements provide valuable insights into a company's financial health, but they can also hide potential risks. Recognizing the red flags listed above can help investors, creditors, and other stakeholders make more informed decisions. Whether it's declining revenue, rising debt, negative cash flow, or issues with transparency, these warning signs can indicate that a company's financial future may not be as bright as it appears. By keeping a close eye on these potential red flags, you can protect yourself from investing in companies that may not be as financially sound as they seem.